Good morning, everyone. Thank you for being here. Today, our group will present an in-depth analysis of the impact of the US tariffs on Richardson International, Canada's leading agribusiness specializing in canola oil. So let's begin with a bit of context. In April 2025, the United States imposed a 25% tariff on Canadian canola oil exports. The official reasons cited were unfair Canadian subsidies and the protection of American biofuel producers. However, this policy had wide-reaching effects beyond those objectives. So our study aims to evaluate both the commercial and operational impacts on Richardson International. We chose Richardson because of its prominent role in Canada's canola oil export market and the direct nature of the tariffs consequences on its business operations. So these tariffs disrupted a critical trade relationship before the imposition. About 60% of Canada's canola oil export went to the US. This trade route was essential for Richardson's profitability and overall industry stability. So with these disruptions, Richardson had to quickly reassess its strategies to stay resilient in an increasingly protectionist trade environment. So our presentation today will walk you through the timeline of events, the consequences, and the strategic responses by Richardson International. Now I would like to call Nagina for, for the presentation.
Thank you, Devosh. Hi, everyone. To summarize, Richardson International faced substantial setbacks. The US tariff reduced its export competitiveness, leading to lower income, squeezed production margin, and increased strategic vulnerability. A critical recommendation from our analysis is that Richardson should focus on expanding to other global markets by leveraging the comprehensive and progressive agreement for Trans-Pacific Partnership and the Comprehensive Economic and Trade Agreement. These agreements offer preferential trade access to many high-demand regions such as Japan, the EU, and Mexico. Now let me explain how we approach this analysis. We applied a mixed method research framework. Our quantitative data came from Richardson's annual financial report and National Trade Statistics Canada. This allows us to assess performance, trends, and revenue change before and after the tariff. Our quantitative data came from interviews, government policies, documents, and industry news. This gave us insight into Richardson's internal response and sector-wide sentiments. We also performed scenario modeling by comparing actual performance post-tariff with projection based on past trend. We quantified the likely financial damage and molded strategic alternatives. This method gave us a clear picture of what might have happened if Richardson had not taken action. Thank you. Now I would like to call Saugat for next part.
Thank you, Nagina. Let's now explore why canola oil is such a crucial product for Canada and how the US tariffs especially disrupted this sector, especially for a company like Richardson International. Canola oil is more than just a common cooking ingredient. It's a cornerstone of Canadian agriculture and trade. In 2023, Canada exported approximately 2.9 million metric tons of canola oil, valued at around Canadian dollar 6.3 billion. A significant share, about 60% of this volume, was shipped directly to the United States. So when the US imposed a 25% tariff in April 2025, it didn't just hurt Canadian exporters, it sent shockwaves through the entire canola supply chain. For Richardson, the tariff added roughly Canadian dollar $100 per ton in additional cost for Canadian $100 per ton in additional cost for exports to the US, making Canadian oil less competitive compared to American and other international producers. The immediate consequences: Richardson experienced a 15% decline in US-bound canola oil exports. That's a substantial loss in market access and revenue. But the impact didn't stop at the company level. Across the prairie provinces, which are the heartland of canola farming, there was an estimated of Canadian dollar 1.2 billion loss in farmer income in 2025 alone. These are real losses for families, communities, and local economies. The ripple effects continue. Farmer reduced canola acres by 7% due to due to price uncertainty and reduced demand. The global price of canola oil dropped by $100 per ton. It's on Canadian dollar, further shrinking profit margins. Exporters face rising per unit shipping costs because of lower overall values. Warehouse and also warehousing expenses increased as unsold products sat in storage longer than expected. This situation created a perfect storm: declining revenue, rising costs, and growing market uncertainty, all triggered by a single policy decision from a major trade partner. Richardson, being one of the largest exporters, was hit hard. But as you will hear next from Suniksha, the company responded with a mix of bold strategic moves and operational shifts, showing how resilience in trade requires both foresight and flexibility. Over to you, Suniksha.
Thank you so much. So I'll be walking you through the strategic response and operational adjustments done by Richardson International. In spite of these setbacks, Richardson didn't stand still. The company utilized a combination of key operational and money-related reactions. Let's begin with the market diversification. Richardson started focusing on unused markets such as Japan, South Korea, and Mexico, nations with developing requests for canola oil and favorable exchange conditions beneath CPTPP and CETA. Following was logistic modernization. Richardson embraced AI-powered course optimization devices to decrease conveyance cost and progress shipment, unwavering quality. Cargo union strategies, moreover, made a difference to diminish shipping wasteful aspects. On the financial side, Richardson negotiated provider contracts to share chance and actualize supporting techniques to ensure against assist cost instability. In terms of policy advocacy, the company worked with the Canola Board of Canada to campaign for discretionary weight and arrangement alterations that might calm the duty burden. Most critically, Richardson's bonded warehousing permitted them to delay duty installments, whereas looking for elective goals for stockpile merchandise. This was a keen short-term workaround that bought the company time to alter. In all, Richardson illustrated a tall degree of operational dexterity and key premonition in overseeing the aftermath of the US tax. For the conclusion and our interview question, I'm going to hand over to Dipesh. Thank you.
Thank you, Suniksha. I'll talk about interviews, lessons, and conclusion. To gain deeper insight into Richardson's internal challenges, we proposed a series of interview questions. Questions are like this. How have the tariffs affected export competitiveness and relationships with the US clients? What specific cost control measures have been successful? How has inventory and supplier management evolved? What contingency plans exist if tariffs escalate? How could CPTPP and CETA be used more strategically moving forward? From Richardson's case, we identified 4 key lessons that other agribusinesses should consider. 1. Strategic adaptation. Companies must remain flexible and adapt quickly to sudden regulatory changes. Second, market diversification. Relying on a single export market is risky. Diversified trade reduces vulnerability. Third, logistics automation. Investing in modern logistics can significantly reduce operational cost and maintain delivery performance. And the last, long-term resilience. By building flexible operations and financial buffers, companies can weather future trade disruption more effectively. In conclusion, Richardson's proactive and multifaceted response to the US tariffs sets a powerful example of strategic resilience in international trade. Thank you for your attention. We now welcome any questions you may have.